Okay, as Steve mentioned, my name is Andrew Jones. I work with a company called Timbercreek Asset Management. I've been kicking around the commercial real estate industry for about 20 years, and I've been with Timbercreek. I've been involved actually since inception, and been there full-time for about 6 years now. I'm going to just talk quickly about Timbercreek and then the different real estate investing options, then touch on the sectors, and then get into the market and investment fundamentals of the Canadian landscape of the Canadian marketplace. And then we can talk a little bit about investments today. So Timbercreek is an asset management company. It was founded by a couple of my partners about 13 years ago. We currently manage $3.2 billion. We have three buckets that we use for investing. We have a private equity bucket, which effectively means we buy real estate. We buy apartment buildings across Canada, a couple $1 billion there in 6 funds. That's all institutionally funded. And then we have private debt, which is really what I focus on. We have 2 publicly traded mortgage investment corporations that total about $1 billion. And we have public equity and debt funds. So those are funds that invest in public real estate stocks, bonds, and other derivatives. All in about $3.5 billion. Just to comment, our focus at Timbercreek is the commercial real estate market. I will talk about housing today, but we are really investment real estate specialists, and we focus on the commercial market, primarily in Canada, although we are now starting to expand globally. Our real estate securities funds are global real estate securities funds, and we are now buying assets in the U.S. So the different options, there are a couple ways to invest in real estate. The first is investing in the equity. Investing in the equity effectively means that you're buying the properties. You're taking in an equity interest in the properties. The equity is typically a more volatile investment. Your investment's going to fluctuate in its valuation. It's going to go up and down at different times. But if you pick the right investments, your timing is okay, and you have a good manager, there's a good upside in long-term real estate holdings. The debt side tends to be a lot less volatile. It's probably, I liken it to a more fixed income type investment. Investing in real estate debt will not bring you any long-term upside, but you do mitigate the downside when investing in debt. So if there is a correction in the market, you will not likely get impaired in the short term. So equity investments, how can you do this? Well, there are a couple ways. Probably the most obvious way is to invest in real estate investment trusts, REITs, or other publicly traded vehicles. REITs can be public or private as well. REITs are good in a lot of ways. You get the benefit of very professional management. You typically get diversification, and then you get diversification, but not just by property type, but by region. So REITs can be a very good choice. The challenge with REITs, as we've seen in the last couple of weeks, is that they can be the value on the public markets can be up or down depending on the sentiment in the markets and a variety of other factors. The other option is to invest directly, and direct investing in real estate can be very lucrative. The challenges are what you don't get, or what you do get in REITs. You don't get diversification very easily unless you have a lot of money in a very large portfolio. You'd have to build your own management team or hire your management. So there are constraints to building a proper investment portfolio that way. With debt, it's not dissimilar in the sense that you can invest in mix or mortgage investment corporations and different types of mortgage funds, both public or private. With these, again, you get the benefit of management. I think it's a very important factor in mortgage management. I would say that you get diversification for the most part, and then you get some liquidity, so you can actually trade your units if necessary. If you're investing directly in mortgages, if you make the right choices and if your timing is right and you know what you're doing, your yield can be very good. The challenge is that you need professional management to do this. You need people who know what they're doing, how to manage the mortgages, and then you're sacrificing diversification. So it's tough to invest in 25 or 30 or 50 mortgages if you're not involved in a fund. So the different sectors, we really break down real estate into a couple of sectors. at 30,000 feet at a very high level, and that is housing. What I include in housing is single-family housing as well as condominiums. I would say the way I distinguish this is housing owned by what I call the end user, or someone who occupies housing for the most part, or an individual that invests in housing. So, all of us in the room likely own houses, or most of us, and that would be what I'm talking about when I'm talking about the housing sector. Commercial investment real estate is the other sector. That includes multifamily residential rental apartments, office buildings, industrial buildings, retail buildings, primarily cash flowing properties, and then some development. So on to the two different sectors. So housing is dominated by individuals. Housing is typically region specific, and there are a lot of factors that affect housing. Economists will tell you that employment and interest rates are probably the most important things that affect housing, and because you have varying employment in different parts of Canada, it's very tough to predict what housing is going to do in different areas. As a whole, predicting Canada's housing market is tough because you have different pockets where employment's very, very strong, like Alberta, and where things can be more difficult. But to further complicate things, you have these non-monetary factors, non-quantifiable factors such as emotions, psychology. I mean, people buy houses because they like them, because they love a kitchen or they love a bathroom, or they like an area or they like a school. So there's all these emotional factors. People sometimes are feeling wealthy, or they're feeling not so wealthy, or they're worried about their job. Psychology can play an important factor. And then again, we have supply. If you have a lot of building in one area and not a lot of building in another, or if there's an oversupply, if you just have a couple of ambitious developers in a small market, that can flood the market and hurt the housing market in that particular pocket. So, all these factors contribute to housing being difficult to predict. The commercial sector, as I mentioned earlier, is really made up of a variety of asset classes, and for the most part, they're cash flowing properties, multi-residential, office, industrial, etc. In Canada, the commercial market's dominated by institutions. REITs are a big one. Pension funds own a lot of real estate in this country, and then there are a lot of large real estate companies, both public and private, a lot of foreign investment as well. So you have what I would say larger institutional players dominating the market across the country. What affects the commercial real estate are the fundamentals of that, so things like rents, interest rates, and then supply and demand. Does it make sense to add new supply? Can you make the numbers work? Can you build a building, and in the end, is it a good investment? Does it match up against existing investments? So you have a variety of factors affecting this. Now, the commentary, market fundamentals. So the Canadian market fundamentals. So I'm going to start with housing, and this is, the sort of million-dollar question. It gets a ton of press in Canada. The Canadian market, is it in a bubble? And I would say that my view, and I think my firm's view, is that the Canadian housing market is overall quite strong right now. We don't think it's in a bubble that's going to burst. We think that volumes of sales will come off, and we think that prices in certain areas will come down. I don't think it's going to be a dramatic decline in prices. I think volumes actually will come off a fair bit, and we have seen this. I mean, the last 18 months have seen volumes slide back significantly in Canada. New housing starts, trading of existing supply. So, that's the view. But the market in Canada is very fragmented. So you can have, as I mentioned earlier, a very healthy, strong market in one region and a very challenged market in another region. So the easiest way, I think, or the only way I can really make sense of these things is by looking at them region by region. And so I'll start from west to east and go through a couple of provinces to illustrate this. So let's start with BC. So BC, which gets a lot of hype because of Vancouver, that is a remarkably strong market in Vancouver, not just for housing, but for condos, which I'll talk to in a second. But the condo market in Vancouver has come off dramatically. Their condo starts has fallen significantly. We've seen the numbers come back by not just 5 or 10%, but significantly higher. And the high end of the housing market has come back substantially. So, to give you examples, these $8 or $9 million houses are now trading at $6 or $6.5 million. So, they went from prices that were astronomical to prices that are still astronomical, just not as astronomical, right? So, it doesn't mean the market's dead. I think the blowout price on that house is now $5.5 to $6 million. It's not an unhealthy market. So you have all this hype in Vancouver, but if you go outside of Vancouver, the rest of the province, the market's actually been very soft for the last 5 years. Housing in places like Kelowna has been hurt very badly. Prices in certain regions of Kelowna have come off 30 or 40%. And still sit 30 or 40% off the 2006 highs. You have the same thing on Vancouver Island. You have full projects that are not finished. You have a lot of inventory that's unsold. So if you look at BC as a whole and you accept out Vancouver, you have a market that's been quite soft for the last 5 to 6 years. And I was telling the story to Steve when I was in Vancouver, but I had a shuttle bus driver drive my family and I up to Big White, which is just outside of Kelowna, in March. And the shuttle bus driver was telling me that his son had purchased, he's a retired fellow, his son had purchased a house in 2007 in Kelowna. And the price of his house was still not worth as much as the mortgage on his house. So when we talk about, inflated prices in Canada, you can't, the press loves Toronto and Vancouver, but if you look outside, so let's keep going east. I'll talk about Alberta quickly. Alberta, Calgary and Edmonton have also not seen significant price increases over the last 5 years, since 2005 and 2006. Prices have been fairly flat. Volumes have not been that strong. And I had a conversation with a developer in in Edmonton about 3 weeks ago. I was having dinner with him, and he said to me, I see the light at the end of the tunnel. I think the housing market in Edmonton is finally starting to improve. Which is an interesting comment because, the papers would have you believe that it's a huge bubble that's going to burst. They've just had very tough time getting rid of their inventory, building out their houses, been very slow, prices have not moved. And if we go a little further north to Fort McMurray, which I think most of you know is an oil town, I was in Fort McMurray doing some research on the real estate market, and it was confirmed to me that the average house price in Fort McMurray has now exceeded $900,000. And the $900,000 house is not anything as nice as you would get for $900,000 even in Toronto. It's something that would look more like a prefabricated home. It's 3 bedrooms on an okay-sized lot in a suburban neighborhood. But the average family income in Fort McMurray is now $185,000 a year. So probably an affordability, but Fort McMurray will clearly skew the entire Alberta set of numbers. So if we keep coming further east, I love talking about Saskatoon, because Saskatoon is a place right now where you can buy a house, a very nice house, for around $300,000 and $350,000. It seems like a pretty decent price, particularly given the fact that Saskatoon has virtually 100% employment. They're importing workers. They have a very good wage. I think the employment is sustainable for the long term, and I think that the incomes that people, or the wage that they're paying, is more than enough to support that $300,000 or $350,000 house price. The average house price in that same town 10 years ago was $65,000. So when you do the percentage increase over the 10-year period, it looks like you had an absolutely astronomical growth in house prices. But really, you've gone to what is a much more normal, you've gone from a very depressed house price because of the state of their employment market to something that, it looks quite inflated on paper, but it's actually, I think, a reasonable number. So again, you have these anomalies or these outliers that are skewing numbers, I think. And then, Ontario, which is near and dear to our hearts here, Toronto has had a healthy increase in house prices. There's no question. There's probably room for it to come back. But outside of Toronto, places like Windsor or London, Ontario, or Thunder Bay, outside of Ottawa, for the most part, we are still not back at 2006 and 2007 level house prices outside of those two cities. So you can see how difficult it is to predict the housing market. So what does this all mean? Well, I think it means that, overall we could have some volatility still, but I would say that interest rates are probably going to play a more significant role than anything else in movement in the housing market. So if we do see rates increase quickly, I think it will slow the housing market. I think it will, impair values to some extent. But I don't think anyone expects a sharp rise in interest rates over the next 18 to 24 months. And Steve might disagree with me, I'm not sure. So before I leave this, 2 comments on the housing market. Number one, because we do get compared to the U.S. a lot, and I wanted to just make 2 comments on this. Because they are saying, Canada's now in a U.S.-style correction coming. But the U.S. had a very different situation going on. The U.S. were securitizing a huge portion of their loans. The loans that they were securitizing were going into pools, and the people who were placing those loans were incented to do as much business as possible, and they were able to do loans that we call ninja loans. And ninja is an acronym for no income, no job, or assets. Right? And this is true. And these people did not have a hope of carrying their houses for more than 6 months, and that's because there were these interest-only or low interest rate periods, and the rates would adjust, et cetera. And then they were refinancing on a regular basis at higher prices, and this created this bubble. We do not have that here. The banks and all the lenders in Canada are credit lenders, and we always have been. We also have something called personal guarantees. So when you borrow a mortgage here, when you borrow money on your house here, you're actually on the hook for it. You can't just walk away with it. It will affect your credit, and it will affect, the bank can litigate to get their money back if they don't retrieve everything. So we have a very different situation here. The second thing is that it's a stat that doesn't get quoted very often, but it certainly raised my eyebrows. And it was reported in the Globe and Mail about 6 months ago that 40% of Canadian homeowners do not have a mortgage, which to me is a staggering number. So on to the commercial market. So this is where I spend most of my time. And Timbercreek in general, we are investing in the commercial market. So the commercial market's made up of a few segments, and I'm just going to take you through, where I think the market is today on these segments. Multifamily, which is apartments, that is where we invest actually. So we're very close to this market. The apartment market, or the rental apartment market across Canada, is characterized by very low vacancies. The math does not work to build new product in Canada. The reason it doesn't work is that the land is too expensive, construction's too expensive, so most of what's trading today is trading well below replacement costs. So because you can't add supply, what you end up with is a very tight market. So vacancies are low. Now, you would think that rents have run up substantially, but we do have rent controls in most places in the country of some sort, and really rents haven't been up that much. So you would be looking at fairly reasonable increases over the last 5 years. So the fundamentals of the apartment market we think are very, very strong. The one question is that the returns that people are willing to accept, because this is the most stable cash flowing property you can buy, because of the returns today that people are willing to accept, which are very low, meaning capitalization rates are very low, we think could adjust and could adjust with interest rates adjusting. The office market in Canada is dominated by institutions. Almost every major office building in this country is owned by either a Canadian pension fund, a foreign pension fund, or a Canadian REIT. And actually the REITs aren't big players in office. So it's very tightly held. The supply is not been increasing. There's very little building, with the exception of Calgary, which is really an anomaly. I think that the Calgary market is healthy today, but it's very volatile. It's a market that we've chosen to stay away from because I find it scary, frankly. They've added a lot of supply over the last few years, and it did flood the market for a while, but it's tightened up now. But overall, the institutions control that market, and so if times are tough, they don't even drop rents because they don't have to. They have no debt on these properties. They're $100 billion pension funds that own these buildings. They can wait. The retail market, this is an area also dominated by pension funds, but also REITs. There are a lot of REITs like RioCan and Callaway that own a lot of retail. We are relative to the U.S., we're very under retail. Per capita, we have a lot less retail space per square foot than the U.S. does. My opinion is that they're over-retailed, so I think we're in a healthy spot right now. The developers are building retail. There's a lot of new retail, or there has been over the last few years, but it's supportable for the most part. And again, I think the rents that are in retail market today are affordable to the tenants. So the tenants are generating enough sales to easily pay those rents. You really want your rents to be in around 10% of the sales in the property or less, and that is the case today. Development land, that's a tricky subject. The one thing I will say about land and development in general is that the price of land in good locations, particularly infill land in cities, has gone up substantially in the last few years. Condo land, even though the condo market has come off, which I didn't talk about, but I will later. The commercial land, industrial land, etc. The prices are up, and it is making it trickier for the developers to produce product, which is keeping the market tight. But prices are expensive, so it is a sector that I think could pull back a little bit. I don't know if I'd call it healthy. I'm not sure I really understand the prices that are being paid. And then there's industrial, and the industrial market, again, is an interesting market because I would have said that I thought there was a lot of money chasing industrial today, and the industrial market is more volatile than some of the other asset classes because for example, if you have a fluctuation that's 10 or 15% in the Canadian dollar, you can hollow out a good chunk of the Ontario manufacturing community and actually hurt your industrial vacancy. And we saw this happen. Today I see players in the market that are trying to accumulate industrial and paying prices that I thought were expensive. But then it was quoted to me a couple of days ago that industrial rents in Toronto, in Greater Toronto, 20 years ago were $4.50. If you inflate that by 2% non-compounded for 20 years, today the rate should be $6.50, which would be a very reasonable increase for 20 years. And today, you can't get $6.50 for an industrial rent, which is interesting. So they're telling me we should be buying industrial. I think it's a tough call. And then finally, the only other asset class I wanted to touch on is retirement, because it's an asset class that we actually do a lot of work in. It's an interesting asset class. Retirement is a business as much as it is real estate. You have to have a very good operator. Operators can make or break a retirement home, whether, and there's different levels of care, et cetera, but you need a good operator there. And then the market, for a while, there are pockets that were flooded where you had a lot of new product come in because there was a construction spur, et cetera. But today, there's the demographic and the numbers would suggest that there's going to be a very significant shortage of retirement home rooms available based on demographics within 5 to 7 years of today, and that's purely the boomers aging. So, with respect to the commercial real estate fundamentals, the thing that probably affects real estate most in the commercial world is, in terms of fundamentals, is rent, because you're buying the rent, you're buying the return, you're buying the income stream, right? And as I mentioned with the industrial rents, they don't seem out of kilter. They actually seem to be very reasonable. And I think I would say the same for the most part for all commercial asset classes. So, rents in apartments, rents in office buildings, with the exception of certain pockets, but for the most part, rents have not seen a huge gain in Canada over the last 10 years. And because of that, the real change in valuation, the real run-up in valuation for Canadian income assets has been the cap rate, or the return that people are willing to accept for the real estate. And so, if there's going to be a correction in the Canadian marketplace, it's not, I don't think, going to be because of rents. I think rents are reasonable. I think your cash flows are sustainable. It's going to be because people want a higher return. And today, I think what's happening is that people are accepting the lower return because of lack of alternate investments, number one. But also, I think that there's a perception, particularly by the private investors, that there's going to be inflation at some point in the future, and real estate would be their inflation hedge. So if you start to build in inflation, then you can pay a lot more for your property. And I think today, a lot of investors are paying a big price for the property because they're looking ahead. And they're saying, rightly so, they're saying, well, I'm buying this apartment building, and I think rents are going to go up over the next 10 years, so I'm going to pay a higher price and I'll get a lower return going in. But keep in mind that I've just paid $150,000 per unit for this apartment building, and I know to replace this it costs $250,000. So I know no one is going to build in my block or my whole neighborhood or potentially my whole city for that matter. So there are a lot of good reasons that people are paying the prices they are today, and time will tell whether they're right or not. Investment demand is another thing. One thing I wanted to talk to. I should just quickly on interest rates. The thing about commercial real estate and interest rates is that interest rates have more of an impact on commercial real estate for REITs. When you go beyond REITs, then you have a very large pool of private investors, private companies, private individuals, and then you have pension funds, et cetera. Where interest rates can be less significant is for those private groups, because often they don't require a lot of leverage. Often they're fine accepting a lower return and betting on, to some extent, on capital growth. But for pension funds, they don't even use leverage. So that sort of puts a bit of a ceiling on how high the cap rates will go, and in effect a floor on how much they'll pay. So the point being that even if interest rates go up to 6 or 7%, the pension funds may still pay prices that we're seeing today because they don't care about the leverage. They're just looking at the total return. If interest rates are going up because of inflation fears, they're going to build in higher inflation numbers, and they're going to pay the prices today. So we don't see that even if there's a correction because of interest rates, we don't see it being a dramatic increase or a dramatic, decrease in prices. What we see is a bit of a floor because institutions are going to buy unlevered. And the last thing I want to say is investment demand, and this is really interesting today. It's something that I think is a changing landscape in Canada, and that is that with all the domestic demand from REITs, and then we have a very large demand domestically from Canadian pension plans who have specific allocations to investment real estate. They need to push money into investment real estate. They need to yield, but they also have allocations, and the plans are growing. They're growing rapidly, which is a good thing, obviously. But the other thing we're seeing a huge appetite from foreign investors coming into Canada, wanting to buy real estate because they like the political landscape, they like the fact that they're in a safe country. They just see it as a place to park money, and they don't care really that much about what they're paying for the real estate. They want a reasonable price, but they're happy to pay a little more than the next guy. The biggest issue for foreign investors is that we don't have enough real estate here to satisfy the demand. A Swiss fund came to Canada about 12 months ago with $1 billion check to buy apartment buildings. They bought $150 million in apartment buildings over an 8-month period, got frustrated, packed up, and went home. So they just can't build enough asset base to satisfy their demand. But we are becoming a much more international country, and we're seeing a lot of foreign investment, and right down to international individuals buying condominiums in Canada and renting them out in places like Vancouver and Toronto. And I think that's going to change for us here. So opportunities. As I mentioned, we're not sure where things are going. We are a little bit hesitant. I would say we're in a defensive mode, and so we are not buying any real estate right now in our funds. What we are doing is we're focusing on lending. We're building our mortgage debt funds. What that does is, obviously, it gives you an equity buffer or a buffer from fluctuations in the market. We think that today prices are expensive. We're not sure where they're going to go. We're not sure where rates are going to go in the next 18 to 24 months. So we're taking a bit more of a defensive strategy. I do think that Canada's still a great place to buy real estate with the right manager and with the right, certainly at the right time. I think it's a great long-term hold. But if you're looking for a shorter-term investment, I think mortgages are a good place to be today. Again, because of the fluctuation potential, I think, in the markets. We are also looking internationally, and the way we're doing that is we're really taking some trends in different international, different countries around the world, and we're doing this through our global fund. And we have managers on the ground, which I think is very important. We have understanding the bricks and mortar and the opportunities in the specific markets. And we're able to do that in our global fund, and we think there are significant opportunities there. I mean, the most obvious one is we're taking advantage of the recovering housing market in the U.S., and that's just one of the areas we're looking at. And I think that's it, and I'll pass it back over to Steve.